about short and long run uncertainty, and it's joint work with Nick Bloom and with Ian Wright, who I believe is in the audience. And so just two short disclaimers. One is that Ian worked on this at individual capacity, so these are not the views of BlackRock, these are our views. And the second short disclaimer is that none of the authors of this paper are asset pricers. So for all the asset pricers in the audience, you might want to give us a little bit of slack, but hopefully we'll be able to convince you of some of the empirical findings that we have here. So what is this paper about? Essentially, our motivation for this paper is that there's some very natural horizons of economic uncertainty. So for example, in the short run, we have a lot of uncertainty about whether the US Congress is going to pass new stimulus like soon. So the unemployment assistance has already expired. Airlines got a lot of assistance that is expiring, I think, at the end of September, and American Airlines is basically threatening to cut 20,000 jobs. And so within the next month, this sector has a lot of uncertainty about what's going to happen with them. Like in the next 2-3 months, we don't know who's going to win the presidential election. Joe Biden, according to The Economist, has a 90% chance of winning as of yesterday, but there's a lot of uncertainty about this as well. In the longer run, you can think of kind of longer run policy goals like how or when will the US and China agree to a trade deal? Even longer, like, is the shift to working from home with COVID, this is generating a lot of uncertainty for cities. How much office space are we going to need in New York? Are kind of all of the amenities of New York going to have to change? We have a lot of uncertainty about this. Like even in the much longer run, are we at the dawn of a new age of privately funded space exploration? So Elon Musk has his SpaceX has launching these Starlink satellites that allegedly want to give internet anyone anywhere around the globe. Again, this is kind of maybe decades out in terms of uncertainty, but it's clearly a very different horizon from whether the U.S. Congress is going to enact new stimulus within the next month. So, I mean, kind of giving you that, after giving you that motivation, kind of the questions that we look for in this paper are really, how do we measure these short run versus long run uncertainty at these very different horizons? And the second is, how and why do firms behave differently under short run versus long run uncertainty? And in particular, what sorts of decisions? So is it investment? Is it hiring that is more sensitive to short run or long run uncertainty? And at the end of the day, we're interested in what are the underlying frictions, the underlying mechanisms that potentially generate this differential sensitivity. So, I hate it when this happens. So what do we do in this paper? We are going to propose that we can measure short run versus long run uncertainty using implied volatilities calculated from options that have different expiration horizons. And so this is obviously a virtual derivatives workshop, and so this is how derivatives come into the paper. And then we're going to use this to empirically investigate how short run versus long run uncertainty relate to firm level decisions like investment, R&D growth, and hiring. And then exactly explore the reasons for why we might see these differential sensitivities. And so we're going to do this in 2 ways, or I should say 1.5 ways. First, we're going to compare across industries to see if certain industries, like these effects are concentrated in certain industries or not. And then the second thing, which is really kind of work in progress and I'm not going to have hard results on, is we're going to propose a real options model with short and long run uncertainty shocks and frictions that can potentially explain how firms behave differently under short run versus long run uncertainty. Now, before I go into kind of the weeds, let me tell you kind of broadly what we find. We find that if we use implied volatilities to measure short run versus long run uncertainty, this kind of uncertainty horizon profile, so if you plot the implied volatility at 30 days versus 90 days, a year, 2 years, this profile is very well explained by essentially 2 sufficient statistics, which we're going to call a level and the slope component that account for about 99% of the variance of the whole curve. And so this is kind of our first fact. The second fact that we're going to find is that long run uncertainty seems to be most strongly negatively related with R&D growth and investment. and then less so with hiring. However, investment in physical capital is going to be more sensitive to the level of uncertainty than is going to be R&D growth. And finally, for kind of what are the mechanisms that we think are driving these relationships, we think the different durability, adjustability, and substitutability across these different sorts of investments or firm decisions are at the heart of this. And I'll hopefully be able to get into a little bit of the mechanisms towards the end. Now, this paper is related to a long literature. I think in the interest of time, I'm going to skip this unless there are any burning questions. And so instead, let me tell you kind of where we're going today. So let me begin by telling you what our setup is with short run and long run uncertainty and how we think implied volatility is going to map into that. Then I'll show you the core empirical results about how investment, hiring, and R&D correlate with short run versus long run uncertainty. Then I'll tell you a little bit about the mechanisms and get finally to the conclusion. So let me show you what kind of the setup or the kind of a baby theoretical model that you can think of to fix ideas about what do we mean by short run versus long run uncertainty. So think about an individual firm. I don't have I subscripts here, but you should think of all of this model as applying to an individual firm that can raise revenue by investing in physical capital, in labor, and in knowledge capital. And this production function is going to be subject to first moment shocks that are going to follow the standard log normal AR1 structure. And it's going to have stochastic volatility. So this is going to bring the kind of the fluctuations and uncertainty at different points. And so what we're going to add to this fairly standard setup is say, look, what if this stochastic volatility has two components, more longer run and a more short run? And so how we are thinking of modeling this or our work in progress model does this is these two components have independent two-state Markov chains, and the long run one is more persistent than the short run. Excuse me. So basically, if there are some uncertainty shocks that arrive and they last for a long time, they're persistent. There's others that are here kind of today, and then by the time we get to tomorrow, they've decayed away much more quickly. So what we're going to propose in this paper is that we can measure uncertainty across horizons using implied volatility. So that, and we know that implied volatilities are typically based on 30-day options. So for example, the VIX that gives you the volatility of the S&P 500 is based on 30-day options. So you can think of it as a 1-month implied volatility. But you can apply the same formula to options whose expiration is in a year or two or any horizon that you want really. And so the idea is that these longer run implied volatilities are going to capture more of the persistent shock than of the transitory short-term shock. Okay? And so in principle, this sounds like a great idea. Kind of in practice, how well does it work? So I'm going to argue it's not too bad. So this figure is from a different paper from a survey that I also work on with colleagues at the Atlanta Fed and also with Nick Bloom and Steve Davis at UChicago, where we run a survey that asks firms essentially to provide probability distributions for their own firm's future sales. And so from these subjective distributions, we can get a sales growth uncertainty index that is based on how dispersed the probability distribution. So if an individual firm says that they're very uncertain about the world, the distribution is very dispersed, that's going to tend to raise the uncertainty index. And so in this figure, what we're plotting is the sales growth uncertainty index against the 1-year VIX. So the VIX applied to, so the VIX constructed using options that expire at a 1-year horizon. And the reason why I'm using a 1-year horizon is that's the horizon of the survey data in the sales uncertainty index. And you can see it's not perfect, but there's a clear positive correlation between the two. And so this gives us some comfort that these longer run uncertainties can be captured by these longer run implied volatilities. And here's another example. It's kind of a similar idea. So Kenny and Melo Fernandez created measures of uncertainty, of subjective uncertainty based on the Euro area's survey of professional forecasters. So again, the survey asks people to provide subjective probability distributions for GDP growth in the Eurozone 5 years out. If we correlate that with the 1-year VIX, which you can think of as a measure of macro or global economic uncertainty, again, there's a non-trivial correlation between the two. Okay, so this is kind of a first pass in the raw data. Is this a crazy idea? I'm going to argue it's not a crazy idea. And we're going to run with it. Now, so at any given point in time, we can construct these volatility curves that essentially trace what the implied volatility is at a point in time for options of different horizons. So here, each curve in this figure is showing you the level of the VIX for a given horizon, or constructed using options that expire at a given horizon at a point in time. So for example, this October 2008 dotted line up here shows lots of uncertainty within the next 30 days in the midst of the crash of 2008 and a downward slope, potentially because kind of in the longer run, people kind of knew that the recession and uncertainty would subside. So why am I showing you this? Essentially to convey the idea that there is a lot of variation in short run versus long run uncertainty. And so you can see the level of these curves is changing, the slope is changing at different points in time. And this is the variation that we're interested in. What do firms do when we have very high short run uncertainty? What do firms do when most of the uncertainty is in the long run? And so on and so forth. Now, all of the figures that I've shown you up to now are based on kind of what we're going to call macro uncertainty. So they're based on market measures like the VIX. Oh, sorry, I forgot about this one. And this is another cut that shows you kind of the variation in short run versus long run uncertainty. So this is a time series of the 30-day VIX. This is the usual one that is quoted in the markets all the time against the 1-year VIX that has the 1-year horizon. You can see there's clear independent variation between the two. And in particular in crises, kind of the short run VIX tends to rise up much more than the long run VIX. Now, for the rest of the talk, I'm going to be focusing on firm level volatility and firm level uncertainty. And I think this is the first time I've given this talk where all of the audience probably knows more about these data than I do. So anyway, we're going to go to option metrics, which, as you know, provides implied volatility out of standardized options for individual equities. Our sample period ranges from 1996 to 2016. So as a reminder, these standardized options are kind of theoretical options whose strike is at the money forward price. And the way option metrics constructs them, they give them standardized maturities, like 30 days, 6 months, a year, and 2 years. And then from these options, they basically invert the Black-Scholes equation, and they give us the volatility that is necessary to rationalize the prices of these standardized options as option metrics calculates. Now, one question that we often get is, wait, but aren't options for individual firms whose expiration is a 1-year or 2-year horizon kind of very illiquid and are traded very infrequently? And that's absolutely right. So having dug into the methodology and the manuals for this, option metrics only provides us implied volatility data for a given horizon if there are options trading at or beyond that maturity, and so that they're fairly confident that the implied volatility they can calculate is accurate. And later, when we get to the empirical results, I can also show you that this illiquidity doesn't appear to be driving our results. So we can come back to that if somebody has a question at some point. So yeah, we download this implied volatility data and we aggregate it to monthly and quarterly frequency. Now, kind of, as I said at the beginning, the first fact of the paper is that this volatility across horizons profile is well described by two components that we're going to call the level and the slope. And so what we're seeing in this table is how the first and second principal components is the loadings of the first and second principal components on the volatility is across different horizons if we do a principal components analysis. And you can see the first component loads positively and similarly on basically all of the implied volatilities across across all horizons. The second component, it loads negatively on the short end, but it loads positively on the long end. So this is why we're going to call it a slope component. And together they account for 99% of the variance, of the joint variance of the volatility curve. And so this is true. I'm pointing to the macro volatility, so this is the generalized VIX data. This is also true if we look at it in the at within firm movements in idiosyncratic implied volatility. And so there is variation here, and while most of the variation is captured by the level, so about 90% of the variance, there is meaningful variation in the slope component, and together they account for basically all of the movements in the whole volatility curve. And so why is this an important fact for us? Like I told you, a lot of the time we have missing data at these long run horizons. We don't have these implied volatilities because there aren't enough options trading at those horizons. Well, so what we're going to do is we're going to exploit this fact to say, look, in order to measure long run uncertainty, we only really need 2 points on the volatility curve because we only need to get the level and the slope. And so we can use the 30-day and the 6-month or the 30-day and the 1-year volatility curves to get the slope, and that gives us kind of a full view of the long run of the long run uncertainty. And so here's kind of here's another table that kind of gives you this idea. So if we try to predict these long run implied volatilities at the firm level at a 2-year horizon, which is kind of the longest run horizon that we have, and for the VIX at long run horizons, and if we try to predict them based on the contemporaneous 30-day and 1-year minus 30-day volatility, the R-squareds are pretty good. So for example, this graph is showing you kind of the predicted values from the regression in column 5 here. So how well do the 30-day and 1-year minus 30-day volatilities predict the 5-year VIX? Well, here's the predicted value from the regression. Here's the actual value, and you can see they line up fairly tightly along the 45 degree. So,
Jose, before you get too much further, let me interrupt you. There's a question about the data, so I think it makes sense for me to ask you about the question about the data before you get too much further. From Chris Jacobs, can you talk a bit more about the data? What is the longest maturity IV you use, and where does it come from? And I will interject my own observation. When I saw your paper, my guess is that the implied volatility data are from the totems, but if that's not correct, where does the implied volatility data come from?
So the firm levels are coming from option metrics. I'm not sure if that was the question. And the longest maturity that we get is at the firm level is 2 years.
Right, but for the SPX implied volatilities, you go out 10 years. Where does the 10-year implied volatility data come from?
Yeah, so this is kind of a funny story, the 10-year over here. So Nick used to have a friend who worked at Goldman Sachs and kind of very kindly gave them and gave Nick a number of years ago some data based on calculations from in-house from Goldman Sachs that replicate the CBOE formula on their own proprietary data. And so that's where we got kind of the first cut for this. But nowadays on Bloomberg Terminal, you can get longer horizons of the VIX. So certainly 1 year, and I'm not sure if you can get up to 10, but probably 5 years. You can just download them from Bloomberg Terminal nowadays. The CBOE is publishing that. So, and so actually we have I have done the exercise of correlating the stuff that we downloaded from Bloomberg many years later, and correlated during the sample period that coincides with the Goldman Sachs data that Nick got many years ago, and it's like 99% correlation. So we're pretty confident about that.
Okay, so from Peter Carr, I noticed quotes around level and slope suggesting they are not to be taken literally. That is good, since negative constant slope eventually leads to negative volatility. How would you literally extrapolate vols when slope is negative?
Yeah, that's a good question. So what I can say is that typically there's a positive, typically the slope is positive. So I don't think we run into that issue very much. I mean, you can see it in this picture, kind of the slope turns negative really only in these like episodes of market turmoil, like in 2008 and 2020. I'd have to check. I don't know offhand how exactly we extrapolate that.
Okay. Okay, there are also a couple comments from Gustavo Schwenkler and Tobias Sitcher, but they're comments calling your attention to other work. So Dimitri will send you the chat log afterwards. But anyway, so you don't need to, I won't ask you those. I won't read those comments now, but anyway, Dima will send you the chat log afterward. There's a couple comments calling your attention to related work. But anyway, why don't you go on?
Yes, absolutely. Thanks very much. So again, I think none of the authors on the paper are kind of very much into the asset pricing literature. So we would love more references. And so thanks very much for that. Let me go on. So I was right here and I was actually going to do a pause. So that was a great moment for questions. So yeah, as a reminder, where are we? We've proposed these implied volatilities as measures of short run versus long run uncertainty. And I've hopefully convinced you that these level and slope components are pretty, that these level and slope components are pretty good descriptors of the entire volatility curve. So the next item on the agenda is to ask ourselves kind of, how do firms behave differently when the level and the slope is high and vice versa? So what are we going to do? Essentially, the question is, how do firms behave differently under short run versus long run uncertainty? And we're going to answer this by merging our firm level implied volatility data to accounting and financials from CompuStat. And we're going to run regressions of this form where we have an outcome of interest, which is going to be either capital investment or changes in employment, so net hiring or R&D growth at a quarterly frequency. And we're going to regress these on a firm fixed effect, a time fixed effect, on the level and the slope of the implied volatility curve, as well as some first moment controls. And so the idea here is we want to figure out what the conditional correlation is between movements and the level and the slope of a firm's own implied volatility curve. How does that correlate with these investment measures? We include these first moment controls because I think we are very far from being able to argue that these movements in the volatility curve are exogenous. So uncertainty, we're not going to be able to interpret these coefficients causally. And so we want to include controls like Tobin's Q, sales growth, and the availability of cash flow to see how much of the relationship, how much of these first moment controls can actually explain movements in investment as opposed to movements in the volatility curve. So yeah, I don't want to push these regressions as being causal too much. We do try to do what we can. So for example, we measure the volatility curve. You see this has a T-1 subscript with a lag in order to reduce some of the mechanical, maybe this firm has just dropped investment, and so uncertainty or volatility in the market about a particular firm is very high now. So by including the lag, we mitigate that sort of endogeneity, but we cannot argue that these are causal. Now, I'm probably boring you with all this talk, so let me just kind of show you what the result is. So R&D growth, investment, and hiring all decline with short and long run uncertainty, but there are nuances to this. So if you look at column 1, we regress investment on the 30-day and the 6-month minus 30-day volatility. They're both negative and significant. If we do the same with the growth rate of R&D from quarter to quarter, what we find is that they're still negative and significant, but if you look at the coefficients, the coefficient on the slope component is much bigger for R&D than it is for investment. And column 3 kind of tries to wrap up columns 1 and 2 together by saying, by using R&D growth minus investment on the left-hand side, and what we get is a positive coefficient on the level and a negative and insignificant coefficient on the slope. So what is this telling us? This is telling us that investment seems to correlate more strongly, negatively, with the overall level of uncertainty, with the level of the vol curve, but R&D growth and investment more or less equally correlate with the slope component. They both drop significantly by a similar magnitude when long-run uncertainty is high. Then columns 4, 5, 6 repeat this exercise looking at investment versus hiring, now at an annual frequency rather than a quarterly. And the reason is that employment is only reported annually in Compustat, so we need to switch here. But you see that something similar, investment is negatively and significantly correlated with both the level and the slope of the vol curve. Hiring is when we look at the ratio of the two coefficients, hiring loads relatively more on the level, so on the overall level of uncertainty rather than short run versus long run. And that intuition is corroborated when we regress on investment minus hiring in column 6. So two negative coefficients, investment reacts more to the level and more to the slope. So maybe this is a good time to pause for questions, because this is kind of the key empirical result of the paper. I don't know if there are any.
Well, so there's not any outstanding questions right now, but actually, since you're inviting questions, I'll say if anyone has a question, they should feel free to use their microphone and ask it.
Hi, everybody. So this is Aurelio. So I have a question. Like, I see here that the lag, that you use the lag of the log of the 30-day implied volatility. Like, what is the reasoning for that?
Yeah, so the reasoning for that, I went through that a little bit quickly. The idea is, we believe there is a causal story here. We believe that when uncertainty is high, firms become more cautious, and so they drop their investment and their R&D, and they drop their hiring. But there could be feedback and reverse causality from firms dropping their investment, and then the market's kind of getting scared about what they're doing, and then that could raise the level and the slope of the volatility curve. So by regressing on the lag of these uncertainty measures, we're trying to mitigate some of these reverse causality concerns. I don't think we can argue fully for a causal interpretation, but that's the idea.
So I'm looking at the legend. What's the sample period here?
The sample period is between 1996 and I can't remember if it's 2016 or 2018, until fairly recently. So, I mean, 1996 is basically when option metrics starts, and at some point we download it up to 2016. Yeah, so we have found some relationships change a lot across time. The ones that I'm showing you here don't, as we've expanded the sample with more years, they're fairly robust. So I guess if there's no other questions,
well, let me ask the one that I'm thinking about, right? So maybe we believe that implied vol is stationary, right? But in your sample period, it doesn't really look stationary, right? It was really high in late 2008, early 2009. I mean, it just took a couple of big swings, right? So, I mean, maybe even if in our hearts we believe that implied vol is stationary, in your sample period, it plausibly looks like a non-stationary process.
Yeah, I think that's a fair point. So I don't believe I have this robustness check with me, but things don't look too different if, for example, we exclude NBER recessions, so 2008 and 2001. That doesn't totally destroy the results. What else? Right? Do keep in mind that these are firm level regressions with fixed effects, so all of this has a time fixed effect. So if there's kind of big uncertainty in 2008 for everyone, that's not being captured in the coefficients of interest. But I mean, yeah, that's a fair point. Okay, I think I'm going to move on then. So yeah, so this is the same result. So I told you in the first version of the table, we use 6 month minus 30 day to measure the slope of the vol curve. If we use 1 year minus 30 day, the pattern is basically the same. So really, again, this is kind of a robustness check to say, look, even though we're using kind of the short end of the vol curve, in order to get at the long run uncertainty. It doesn't really matter if we move to using a slightly longer run implied volatilities. So to recap kind of this empirical section, investment in R&D and hiring all appear to be sensitive to short run versus long run uncertainty at the firm level. Investment in R&D are particularly sensitive to long run uncertainty, and in particular when long run uncertainty is higher than short run uncertainty. But investment is more sensitive to the level than is R&D. Now, kind of one implication, and here you have to really have to believe the causal story, is one where long run uncertainty may be particularly damaging to investment innovation and long run growth. So events that create lots of long run uncertainty, like for example Brexit, where suddenly the UK woke up one day and there was a lot of uncertainty of what the trading relationship with the European Union was going to be 5 years out, and several years after the vote, we still don't really know how the UK-EU economic relationship is going to be. If you believe our regressions and you believe the causal story, then this does not bode very well for the UK economy, because it means that they've had depressed investment, innovation, and will probably have depressed long-run growth for some time. And by the way, there's a related paper by Ravi Bansal, Max Croce, I can't remember Liao's first name, and Sam Rosen, who make a similar argument using aggregate R&D data. I saw there was a raised hand. So.
Yeah, hello, can you hear me?
Yes.
Hello?
Yes.
Yes, this is George Constantinidis. Maybe a more meaningful way of comparing the sensitivity to short versus long run uncertainty is to tell us one standard deviation of the short-term uncertainty versus one standard deviation of the long-term uncertainty. Because comparing the regression coefficients by themselves does not give me that information.
Yes, absolutely. That's a great suggestion. I don't have that. I don't know that off the top of my head. Yeah, point taken. Thanks. So yeah, these are kind of the core empirical results. Now, I guess where we want to go for this is, look, if there is this differential sensitivity to short versus long run uncertainty, kind of what is driving it? What are the economic mechanisms behind this? And so the hypothesis that I'm going to put forth today is one where firms with less adjustable and longer lived physical capital are more sensitive to long run uncertainty. Okay, and so we're going to test this kind of more in full in exercise 1 that I'm going to show you today, where we're going to look at industry level variation, and so bring in BEA data from how much of physical capital in a given industry in a given year is coming from structures versus equipment as a rough proxy for adjustment costs, and also on the rate of depreciation for physical capital in a given industry. And so where low depreciation means high durability, and so if you have very highly durable investments in your industry, then you're probably going to be more affected by high long run uncertainty. You're going to be more responsive to it. So this is the exercise that I'm going to show you today. The second exercise, which, as I said at the beginning, is still kind of work in progress, is one where we estimate a real options. We want to estimate a real options model with lots of frictions and see what are the frictions that are necessary to replicate the empirical results that I just showed. So here's kind of a first cut. So we regress investment, hiring, and investment minus hiring on the level and the slope of the volatility curve, the same first moment controls that we had before, but now we split the sample based on industries, for industries that have a low share of structures, below median share of structures in physical capital versus high share of structures in physical capital. And you can see that the relationship is much stronger for those industries in which there's big share of structures, so there's potentially capital investments are very hard to adjust, very hard to reverse. We see the same thing in columns 3 and 4 when we use hiring on the dependent variable. And again, when we look at investment minus hiring, kind of the same intuition is there. All of the results that we had in the previous table are kind of driven by the half of the sample in which there are potentially high adjustment costs. And this looks similar, not 100% similar, if we do this at the quarterly frequency, comparing investment and R&D. So for investment, you can see that the relationship is again driven by high adjustment cost and physical capital. For R&D, it's the opposite. So it's firms that have low structures and physical capital that are driving the R&D relationship. And so this seems to go against our hypothesis. My interpretation of this is these are the low structures firms are the ones that are very intangible capital investments. And so they're the ones that should be reacting to R&D. And again, in columns 5 and 6, we kind of see the mixed picture between that comes up from the first two columns and columns 3 and 4, where investment is more reactive to the level and also the slope of the R&D when there's high structures and physical capital. We can do the same exercise if we instead split firms according to whether they have highly depreciable or very durable capital. And you can see that, again, here the relationships are driven by industries in which there is low depreciation. So investments last for a very long time, and firms are presumably more cautious when there's long run uncertainty from investing in highly durable capital. And so here it is for investment, for hiring, and for investment minus hiring. Okay. And yeah, here it kind of works also pretty well for investment versus R&D growth. Again, all of the stars are in the columns that have low depreciation. So this is a plausible story given to us in the data. I think, so what's really the work in progress in the paper when we really want to go is, look, we don't really have an argument for these relationships being causal, and we don't really have an argument for what are the economic mechanisms behind them. So let me tell you a little bit more about the real options model that we're building, and we're trying to solve and estimate to try and get at these mechanisms a bit more. So again, think about a firm that can raise revenue subject to some shocks that are Hicks neutral. They can invest in physical capital. They can hire workers and invest in knowledge capital. They make dynamic investment and R&D decisions. So there's capital accumulation in physical and knowledge capital, and they choose labor statically. And there's lots of frictions in the form of adjustment costs. So there's adjustment costs on the capital stock, like irreversibilities or convex adjustment costs. The knowledge stock has no resale value. So if you invest in organizational capital or you invest in R&D, then if you don't really want these assets anymore, you can't really sell them. So that's a pretty strong friction. And the other friction that we're considering is downward adjustment costs on the flow of R&D. So the idea here is you can ramp up your R&D very quickly, you can hire lots of scientists, but if you later want to close the lab down or scale it down, that's very costly. And so this is going to make you cautious about growing R&D too much when there's lots of uncertainty. And as I had in the beginning, this is a model where there are first moment shocks with stochastic volatility and the long run and the short run component. And so again, the idea is the persistent component makes a firm more volatile at longer horizons. And so this is the model that we're working on. We haven't quite solved and estimated. And the idea is to try to estimate it on the main sample and on the subsamples with high and low structures and high and low depreciation. And the idea is to figure out kind of what are the parameters that change across these different samples. What are the ones that are generating the differential sensitivity? Is it, for example, the durability of physical capital? Is it the magnitude of the physical capital adjustment cost? This is what we're trying to get at when we looked at structures versus equipment. Is it R&D intensity? So on and so forth. And so I think I'm nearing the end. a little bit ahead of schedule. So let me conclude and then we can have a little bit more about questions and this discussion. So what have I shown you today? I've argued that the level and slope of implied volatility curves are essentially sufficient statistics for short and long run uncertainty. R&D growth and investment are particularly sensitive to the slope component, more so than hiring, and investment is more sensitive to the overall level than is R&D. And kind of the next step that I've already showed you a little bit about, but where we're really trying to go with the model is to think about what are the mechanisms driving these relationships? Is it the durability, adjustability, or the complementarity across different types of investments? I showed you the industry comparison, but really where we need to go is to solve the model. So yes, thanks very much for your questions so far. I'm happy to hear a few more, and thanks for inviting me again to present here.
Great, thank you very much. So at this point, anyone who wants to ask a question should feel free to unmute themselves and ask it using the microphone. Can I ask let me ask a very simple question about this data then, right? So
yeah.
If I lease my buildings, then my structures is zero?
I believe these are based on asset use rather than what's literally on balance sheet. So in particular for the BE data, I'm pretty sure that's the right answer.
All right.
I believe in CompuStat as well that the capital stock data includes capitalized leases and that sort of thing.
All right, thank you. Other questions? All right, no other questions. Thank you very much, Jose.
No, thanks very much for inviting me. Pleasure to be here.
Well, as Neil said, we thank you, Jose, for concluding this early career researcher series. And we hope that everyone is going to join next week for the beginning of a 5-week stretch of the CDI conference. So new format, we'll see how it works. But we definitely hope to see you all there next week. In the meantime, have a good week. Ciao, everyone.
Thank you, Jose.
No, thanks for having me.